This is the study session on financial reporting and analysis and the reading on long-lived assets. Two types of long-lived assets, and so I want you to make sure that you distinguish between the two. There are tangible and intangible long-term assets. So I want you to think of the tangible assets as the buildings and the pieces of equipment and machinery that companies use to manufacture or to produce or to assemble their finished product lines. Think of the giant ovens in a bakery. Think of the various types of saws in a furniture manufacturing factory. But then for intangible assets, think about assets that really don't have a physical presence, but clearly they're an asset and clearly they pay off over the long term. When I think of intangible assets, I always think of the National Football League. You guys have been watching my videos, know I like to give sports analogies. The NFL is trademarked, those three letters, NFL, and if it shows up on everything. It shows up on the cities and the teams and their equipment and the stuff that they sell to the public. And what that does is identifies it as an NFL asset, and then it prevents other people from using it. Like, for example, if I'm a large company that makes soup and I want to try to get some new recipes for soups that I can make, and I invite a bunch of cooks and I say, hey, bring your super bowl. Well, I can't use that because the NFL has trademarked the term Super Bowl. That's a silly example, but maybe it'd be one that helps you memorize some of this stuff. All right, let's get into the LOSs. Distinguish between costs that are capitalized and costs that are expensed. All right, so this is a big deal. If we're going to expense one of these costs, and remember, these machinery and equipment, they cost, sometimes tens of millions of dollars, hundreds of millions of dollars, even billions of dollars. If we're going to expense those, think about what that giant balloon expense looks like on the income statement. It's going to wipe out all the other revenues that we're generating. And so we capitalize these costs over the fixed life of the asset so that they are smoothing the income or the earnings of the business over some time. All right, so some costs are capitalized while others are expensed. They're capitalized, you ready for this? Capitalized if they're going to provide economic benefits for more than a year. And so think about the NFL trademark. Of course, the NFL, they've been around since, the 1950s, let's say. And even though attendance is a little bit down, lots and lots of people still watch professional football. So they're probably going to be around for quite some time. On the other hand, if the costs should be expensed, if the economic benefits will probably accrue in a year's time or less. And so there are some good examples under the blue balloons there, acquisitions and upgrades. Think of those things under the left-hand balloon as, increases in the positive net present value of those long-term assets. And then over there on the right-hand side, just think of those expenses as minor. Can I say minor, really? Or smaller, relatively smaller expenses that can be used for repair. And once again, that final bullet point is important to recognize that what the capitalization process does is it spreads those huge costs over the life of the asset, so that there's not a giant hit to operating income and net income and any other kind of income that we've measured in this discussion on financial statements and financial ratios. All right, constructed assets. These are buildings, machinery, and equipment. The international standards suggest that initial construction costs and interest expenses on the borrowing should be capitalized. The U.S. GAAP agrees with all that, and in addition, the U.S. GAAP recognizes that interest earned should be included in that capitalization. How about intangible assets? There's a good definition. Non-monetary assets which are without physical substance and are identifiable. And there are generally three ways that firms can acquire an intangible asset. They can just buy them from another company, or they can acquire another company. And note that the international standards and the U.S. standards are identical for both of those scenarios, recorded at fair value and eligible for capitalization. And that eligible for capitalization has to meet a couple of standards like, is it identifiable? Is it measurable? And it has to be something that's not physical as well. But if these things are developed internally, then the international standards and the U.S. standards, they disagree with each other on the development costs. So the international financial reporting standards indicate that the research expenditure should be expensed and the development costs should be capitalized. Note that U.S. GAAP says that both research and development costs should be expensed as occurred. Now, there's an interesting little sidelight about software development. They're expensed before technological feasibility, and once they are established, then they're allowed to be capitalized. Now, how does the difference between capitalizing and expensing affect, all of the readings that we've been looking up to in the financial statement readings, up to this point? So what are the kind of things that we've been talking about? We've talked about, of course, the balance sheet and the income statement and the cash flow statement. And then we did a whole series on, things like financial ratios and profitability. And so here's a good slide to know. Capitalizing enhances current profits because it spreads those expenses out over time. And of course, when we compute operating cash flow for things like calculating net present value, we're gonna add back those non-cash expenses like depreciation and amortization, so it will increase cash flow. An expenditure that is capitalized. Think about this. We're gonna capitalize a long-term asset. So the long-term asset, of course, that's going to show up on the bottom left-hand side of the balance sheet. So it's going to increase the amount of assets reported, and then it will appear as an investing cash outflow. That big amount is going to show as a one-time cash outflow, investing cash flow on the statement of cash flows. But then in subsequent periods, what's going to happen is there's going to be a depreciation expense or an amortization expense over on the income statement. Remember, those are non-cash expenses that are used for a variety of reasons, for a variety of accounting theory reasons, but primarily what they do is they reduce the tax liability. What expensing does, of course, is it reduces the current period profits, but then since it's expensed today and not expensed in the next time period, it will increase future profitability. And so it will reduce net income by the after-tax amount of the expenditure. And then once this expense occurs on the income statement, there's no corresponding addition to assets over on the balance sheet. And then, of course, if there's no addition to assets on the balance sheet, then there can't be a depreciation or an amortization expense over on the income statement. All right, how about different depreciation methods? And let's go ahead and calculate depreciation expense. So I have a couple of slides where we'll do some math. There's the calculate. You guys know that I love those calculate LOSs. We might as well start with the easiest of the depreciation methods, and we'll call this straight line depreciation. So, here's the simple math. If we spend $100 on a long-term asset and we're depreciating it over 10 years, then that's $10 of depreciation expense over that 10-year period. But of course, what complicates the straight line method of depreciation calculation is an estimate of residual value. And so to get the annual depreciation expense, we take the cost of the asset, the initial investment, the historical cost, subtract out that residual value, and note it's an estimate. It has to be an estimate, right? and then we divide by the useful life or the estimate of the useful life. I remember when I was an undergraduate student as an accounting major, being 20 years old, thinking, man, it must be really difficult to buy a machine today that's going to bake crackers or cakes or something, and you expect to use it for 5 or 7 years, and then what do you think you're going to sell it for after 5 or 7 years? And then I used to think, you know what? If you're maintaining the asset and its useful life is over in 5 years, then why would you want to sell it? Why wouldn't you want to keep using it? But then I studied some more accounting, and I realized that these are really important accounting theory questions, and the accountants have really good answers for these things. Anyway, one final comment here. A lot of companies just assume their estimated residual value is just 0. All right, how about if we take a look at an example? We've got $5,000 worth of coffee processing equipment. That makes no sense to me. I've had less than 5 cups of coffee in my life, so I don't really know anything about coffee processing equipment. So $5,000, there's residual value, $500, useful life of 4 years. So really, we're not going to depreciate the full $5,000. We're only going to depreciate $5,000 minus $500, which is $4,500. And so what we're going to do is take the $4,500 and divide it by 4, and that gives us $1,125 worth of annual depreciation expense. So look in the third column there. First column says years 1 through 4. Depreciation expense is $1,125. So straight line depreciation, that's a fixed depreciation, a constant depreciation expense every year. And so we start with the beginning net book value of the initial cost, and then we work our way all the way down to the bottom right of that ending net book value of $500, which represents the residual value. I guess the accountants think that if we actually sell this for $500 in 4 years, no chance of that happening, right, in the realistic form of life. But then we would owe no tax liability. There would be no recapture. There would be nothing interesting that would happen at the end of 4 years. But of course, nobody ever sells their asset for exactly their estimated residual value. And then accumulated depreciation there in the fourth column, of course, that sums to the $4,500, which should make perfect sense. How about the accelerated method? So going back here just really quickly, straight line, what does that do? That's fixed depreciation expense every year. And so what the company gets is they get a fixed subsidy in the form of a lower tax liability every year. But what happens if the firm wants to accelerate the depreciation and get more of a tax benefit early years and less of a tax benefit in later years? And so when you compute the present value of those things, there's more value to the firm for using these accelerated methods. So allocation cost is greater in the earlier years, of course, and less in the later years. And the amount of depreciation expense is calculated as a percentage. You know, I could come up with Jim's depreciation method, and for a 3-year asset, I could say, all right, we're going to depreciate 95% in year 1, 3% in year 2, and 2% in year 3. So that's an accelerated method. But, you know, as you guys probably can guess, my method, Jim's depreciation method with 95%, in year 1, that's kind of almost like expensing it, right? So the accelerated method kind of breaks out those depreciation expenses, and they tend to decline by some relatively uniform amount over time. So examples include double declining balance and some of the year's digits. Let's take a look at an example of using the double declining method. Let's suppose that we purchase a machine for $1 million. We expect it to last for 5 years. Residual or salvage value is $100,000. Now, if we were using straight line depreciation, we would take the 1 million minus the 100,000 and then divide by 5. But we're going to use the double declining method here. So what we're going to do is we're going to double decline. We're going to double the straight line depreciation amounts. Now, when we compute the double declining depreciation expense every year, we ignore the salvage value. All right, so look at this. We have $1 million divided by the 5 years. That gets us 200,000, right? So let's double decline it. Let's double that amount. So look in the third column there next to in the row 2018, there's $400,000 worth of depreciation expense. Which means if you switch over to the prior column, that the book value of the asset after that first year's depreciation is now 600,000. So what we do is we kind of pretend that we're depreciating this again over 5 years. So 600,000 divided by 5 years, what does that get you? 120,000, right? And then double that. So that gets you the depreciation expense of 240,000, and you just continue to do that down all the way to the bottom until you get to that $100,000 worth of residual value. See how cool that is? And so think about this. This really is an accelerated depreciation method. I mean, look, you start with 400 in year 2018, and 4 years later, or in the year 2022, you're only depreciating, about 30,000 of the assets. So clearly, this is an accelerated depreciation method. So the firm is going to get lots and lots of a lower tax liability early on, and less of a lower tax liability later on. Now, how about units of production? This is particularly relevant for companies that want to match their depreciation expense with an actual production of some kind of a finished good or service. I mean, it makes perfect sense to use, like a straight line depreciation method for a building or a piece of equipment that can be used for lots and lots of different purposes, like you guys know I used to work in the donut factory. They had a forklift. Who knows how much that forklift costs? So maybe it cost $5,000, but that forklift was used for lots and lots of stuff. So that makes sense. But if you can link the production process with the depreciation expense, then the units of production method might make some sense. And so all we're really doing here is taking a ratio of the amount of production that occurred during the course of a time period, like 1 year, versus the total productivity over the life of the asset. If we have a machine that's going to make 1 million donuts over 5 years, and we think that we're going to make, say, 300,000 of those donuts in the first year, and then 250,000 in the second year, and then so on, well, then the depreciation expense makes sense then, should reflect that declining productivity. And that's all units of production method does. All right, here's an example, units of production method. Here's the coffee processing equipment for $5,000. Residual or salvage value $500, useful life 4 years. Now remember that if we use the straight line depreciation method or the double declining balance method, we really don't care about that next bullet point, the productive capacity of 1,000 kilograms of coffee. But now what we want to do is we want to attach that productivity to the depreciation expense. So notice that we've got 1,000 kilograms over the life, but each year it's going to be 400, 300, 200, and 100. So they sum to 1,000. So all we're going to do is take a fraction for each year's productivity and then multiply it by the depreciable amount. So if we take the 400 in year 1 divided by the total of 1,000, that gets us 40%, right? Take 40% of the difference between the initial cost of 5,000 and then the residual value of 500. So that's 4,500 times 40. And that gives us $1,800 worth of depreciation expense. And then we just do the same thing as we move down for years 2 and 3 and 4. We're going to multiply that, the book value by the 30% and then the 20% and then the 10%. And so note that in this case, since our productivity declines, which makes some sense that, the machine, when we first start making this in processing this coffee, the machine is brand new and it's perfect and it's not making any mistakes. And so it's at its capacity, right, for that first year. But then over time, it kind of wears out a little bit, and maybe there's some spoilage. We have to throw a couple things away. Maybe we have to shut the machine down to repair it. And so that accelerates over time. And so once again, this units of production method results in a accelerated depreciation, accelerated, but not in the sense of the accounting acceleration that we did before, but in a sense of the acceleration because the productivity declines. All right, how about this LOS? The choice of depreciation method and assumptions concerning useful life and residual value. So how does that choice of any of those methods affect things like depreciation expense and financial statements and ratios? Well, the accelerated methods are going to result in, of course, higher depreciation expenses in the earlier periods. We said that. What that means then that there will be lower operating profit margin and operating return on assets in the earlier years, but that will then be reversed in the later years. What this also results in is lower average total assets in the earlier periods and then a higher asset turnover ratio. So this is important as a financial analyst to know what kind of depreciation methods, what kind of useful life estimates, what kind of residual or salvage value estimates that the business is making so that we can make a comparison of different companies who do things differently. Remember, the accounting bodies allow a wide range of choices. And so it's not fair to compare a firm that's reporting straight line depreciation with a firm that's reporting double declining balance depreciation unless we know the differences and then we can make adjustments. All right, how about intangible assets? So how did we define those intangible assets? They really don't have a physical presence or a physical substance. You can't really look over there and see a machine. But using my example, when you watch the National Football League and you see these talented athletes throwing passes and leaping over defenders and catching touchdown passes in the air, you look and you think, hey, that's the NFL. And so how do you deal with amortization? So amortization is the intangible asset sidekick to depreciation expense. So what we're doing, amortization is the process of allocating the cost over the useful life, just like depreciation is. Now remember this, an intangible asset with an indefinite useful life cannot be amortized. I wonder what the NFL is doing with their trademark. Is that an indefinite useful life, or do they pick a date where they're going to stop operating? So there's a good bullet point. Useful life is amortized using the same methods as depreciation. But with an intangible asset, it's difficult, more difficult, maybe sometimes even really difficult to estimate that initial cost. So we need an original amount, we need an estimate of its useful life, and then a residual value. And so these are much more difficult and complex compared to an oven or a big saw for the furniture companies. Now, how does the choice of amortization method, and this is similar to what that earlier LOS told us, of course they're going to affect the financial statements. And so shorter useful life means higher amortization expenses each year over a shorter depreciation, over a shorter period. But the total accumulated amortization expense over the life is probably going to be unaffected. If straight line method is used, then it's fixed just like it was with depreciation. If an accelerated method is used, then it'll be higher in earlier years. How about revaluation models? This is allowed only under the international standard. And so these long-term assets, you start with the initial cost, that initial book value, right? Full cost of the asset. You might consider some residual value. But then that book value is lowered by the amount of depreciation expense and, of course, the accumulated depreciation over time. But what happens if the value of the asset changes over time? Can you revalue that asset? Now, sometimes the asset increases in value and sometimes it decreases in value. It's also permitted for intangible assets, but only ones that have an active market. And the standard example there is for, at least here in the United States, we have taxi cabs in big cities and they're given a license, and that license is set to expire after 3 years or 5 years, depending on the city. And so those things are traded, because some people, they like to drive a taxi and they have a license, and then they don't want to drive a taxi anymore, so they can sell it. So there has to be an active market. But it's important to remember that this revaluation, it can result in an increase in value or a decrease in value. And it's probably, if you think about all the stuff that we talked about back in our economics readings, it's probably a reflection of the demand for this particular product line. Maybe the firm is selling way more than they thought they would, or maybe there's competition and they're selling way less. And so under the international standards, there's an opportunity to revalue. And so I think this slide covers the LOS that asked you to describe the revaluation model. But let's go ahead and look at a quick example here. Let's suppose we have a machine costs $50,000, but at the end of the first period, it's worth more than that. Let's say $52,100. And so under the international standards, what can the company do? The company can increase the asset value to $52,100. And so that increase in $2,100 is going to show up as an increase in the value of the long-term asset, and then the corresponding credit over on the right-hand side of the balance sheet is a surplus under equity. But it doesn't show up on the income statement at all. Then part B, suppose the fair value of the item after the second year is down to $4,800. And so then what we need to do is kind of reverse the revaluation. And so instead of showing the asset as, what was that, 52,100, we now show it as 4,800. And then that loss, that reversal, is going to show up on the income statement. So that's probably a big difference to remember here. So let's go back to this slide. This is only under the international standards. GAAP requires you just to use the cost model. And so remember that if you get that on the exam. What about impairment? Impairment is exactly what the name suggests, is you have some property or some plants or equipments or intangible assets in which the carrying amount, the amount shown on the balance sheet, is greater than its fair value or its recoverable amount. And so we have to have a write down. And so when the asset's carrying amount is not recoverable, we'll go ahead and write it down, and an impairment loss is recognized. And so, of course, this is not the answer that you want. That the international standard and the U.S. standards consider these differently. And then you can reverse the impairment under the international standards, but not under GAAP. So let's go ahead and take a look at some of these examples. So impairment, there has to be evidence. And so what does that evidence mean? What did I say earlier? Decline in demand or obsolescence. Think about the machine. I wonder if any of you guys who are parents who have children who are, in their mid-teens now, like I do, about 4 or 5 years ago, they started wearing these rubber bands on their wrists that were in the shape of dinosaurs or penguins or footballs when they were not on your wrist. You could put them out on the floor and look at them all, and then you put them on your wrist. And my kids would wear tons of these things. And so what happens? That was a fad. It lasted for, 2 years or so. And now we have 1 billion of those in our basement. But what about the machine that made those? Clearly those are obsolescent now, that product line. And so what does the firm do? I guess it has an impairment. Now, let's do a comma there. Of course, the companies that make these things, they can easily retool their machines so they can manufacture the next fad. So there's probably not going to be impairment for those kinds of property, plant, and equipment. But clearly there are instances where the long-term asset is impaired. All right, so what happens here is that we have to worry about a couple of new terms. We have to worry about a recoverable amount and the value in use. Now, that value in use is going to be exactly the same thing that we talked about back in the corporate finance reading when we computed net present value. Remember, we had to estimate future cash flows, and so that value in use is going to be the discounted expected future cash flows. And that recoverable amount is going to be the higher of the two, the value in use, which I just described, or the fair value less the costs to sell. Now, under US GAAP, if it's not recoverable, then the measure of the impairment loss is going to be the excess of the carrying amount over the asset, over its fair value. Here's an example. Let's suppose we have a specialized piece of machinery that makes those silly wristbands out of dinosaurs. Demand for the product has plummeted following the entry of a new improved product on the market. All right, so there's the carrying amount of the asset, $21,000. The undiscounted cash flow is $22,000. The present value is $19,000. And there's the fair value if sold, and then the costs to sell. All right, so what are we going to report under the international standard and the US standard? So we have 5 numbers there, and we need to clearly identify which of those are important. So let me go back to that earlier slide. What are we looking for? The higher of its fair value less costs to sell and its value in use. So what do we have here? Fair value less the cost of sell. So that's $20,000 minus the $2,000, which is $18,000. And then how did we define that value in use? The discounted expected future cash flows. So there we go, $19,000. So which one is the higher? And that's the $19,000. So that is all that stuff under the international standard. So let's go ahead and do the answer here. And so I have that there. So the carrying amount is $21,000, right? And then the recoverable amount is the higher of either the $19,000, which was the present value there in the top matrix, or the $18,000 in the bottom. And so the higher of those two is $19,000. So the impairment loss is $2,000. And so consider that against the US GAAP rules, carrying amount $21,000. The undiscounted present value of the cash flows is $22,000. So there's no impairment loss there under US GAAP. How about derecognition of property, plant, and equipment and intangible assets? Derecognition, that's one of those words that sounds like it's made up, but I probably use that word a lot when I teach my students, just because it's kind of the opposite of recognize. It's what you do after you recognize. So remember, what we've done is we've invested huge amounts of capital in our tangible assets and possibly huge amounts of capital in our intangible assets. Well, what if we get rid of them? And so derecognition means that we remove the asset from the financial statements. And so this occurs when the asset is disposed of or expected to provide no benefits. And so how do we do this? We can sell it, right? And we'll probably have some kind of tax consequences, unless for some strange reason the selling price exactly matches the book value of the asset. we can exchange it. And this happens all the time. Businesses have an asset that they don't really want to use anymore, but they see another business that has an asset that that business doesn't want to use anymore. So they agree to an exchange similar to a barter. And so what each business is going to do is benefit because they have maybe different kinds of technology, or they can retool those machines so that they can fit their needs in the future. And then they can just abandon. And I've used several James Bond and Seinfeld examples. You remember when Seinfeld's car was smelling, and so he just took it downtown and abandoned it. So abandonment is a third way to get rid of an asset. I don't know what Seinfeld has to do with accounting rules. Probably nothing. All right, here's a great question. What about impairment and revaluation and derecognition? What is that? How does that impact financial statement and ratios? All right, so impairment, of course, reduction in the carrying amount of assets on the balance sheet, as well as net income. However, impairment does not impact cash from operations. So that's an important bullet point. Revaluations, remember, can either increase or decrease the carrying amount of the assets. So remember those implications for all the financial ratios if long-term assets go up or they go down. But then there's going to be some associated change in equity if there's a surplus, and then there's going to be an associated loss on the income statement if there's a decline in the carrying amount. Now, how do we present all of these things in our financial statements? Of course, on the balance sheet, that's where we put the long-term assets, whether it's tangible or intangible. On the income statement, that's where we show the depreciation expense and the amortization expense. And then in the statement of cash flows, in the investment section, that's where investing cash flows are going to be acquisitions and disposals. And then, of course, depreciation and amortization is in the operating section. And then the notes are really important because remember, as good financial analysts, we're going to read the notes so that we can understand and we can decide about the decisions that the business owners or the executives have made in terms of their choice of depreciation and amortization methods, their choice of the expected useful life, and historical cost by different kinds of categories, and then we'll be able to see accumulated depreciations. Of course, we couldn't get through a reading without asking the question, what does all this have to do with financial ratios? You know, as good financial analysts, it always swings back to evaluating the data on the financial statements, right? That's what we've been doing for all these readings. But then what we need to do as good financial analysts is we need to compute some ratios and do a trend analysis, compare it against the competition and industry averages, and then make a judgment about which firms are undervalued and which firms are overvalued. And so one good ratio to remember here is this fixed asset turnover ratio. In fact, in my undergraduate classes, I ask about fixed asset turnover ratio on every exam in which we talk about ratios. And so notice what's happening here. Total revenues over net fixed assets. And of course, that's an average from last year to this year. And what do we want to do? We want to spend $1 on assets and then have hundreds of dollars in total revenues. But we've got to be careful because that denominator will shrink faster if we use accelerated depreciation and amortization rules. Does that make sense then? So when a firm has a higher fixed asset turnover ratio, we need to ask the question, is it going to be higher because the revenues are higher, which is what we want, or is it going to be higher because the denominator is lower? So make sure that you, whenever you do ratio analysis, and I said this before, make sure you ask yourself what's happening in the numerator, what's happening in the denominator. Now, there are some age ratios that are going to tell us about maybe how old the asset is and then give us an indication of how much maintenance is required and then maybe when it's going to have to be replaced and then what depreciation expense is going to be, et cetera, et cetera. How about investment property? And so this is property that's purchased for the purpose of generating rental income or capital appreciation, or probably both. Under the international standard, you can use either the cost model or the fair value model. Under GAAP, there's really no specific definition of investment property. And so most operating companies and real estate companies that hold this kind of a property use the cost model. Now, leases are really fascinating things because remember what we're talking about here in this big picture of these long-term assets. These cost tens, hundreds of millions of dollars. And so the question then becomes, boy, how can a business get all the benefits of owning the asset without actually having to take all the risks of owning the asset? And that's where this concept of leasing. So the owner of a long-term asset might say to another business, hey, you can have this asset for 5 years or 10 years. Just pay me a certain amount every year. And so sometimes lease expense sounds an awful lot like rent expense, and sometimes it doesn't sound anything like rent expense. So let's go ahead and identify the differences there. So a lease is a contract between the lessor or the owner of an asset and the lessee who is seeking the use of an asset. So in exchange for the rights to use the asset, the lessee makes periodic payments. All right, what are the advantage of leasing an asset over purchasing it outright? Wow. I mean, you can save a lot of money. This is what I suggested earlier on. So it provides less costly financing. There are less restrictive provisions in terms of borrowing because, when you use a long-term asset from somebody else that somebody else owns, you're essentially kind of borrowing it for a while. And then you really don't have to worry about obsolescence or residual value or abandoning it in a parking lot. All right, so let's go ahead and identify the two kinds of leases, and then this will illustrate what I was saying just a few minutes ago. An operating lease, this is kind of like just a rental agreement. There is no transfer, and so the risks and the rewards remain with the owner of the asset. And so with this operating lease, really the only thing that happens is that on the income statement, the lessee will just show a lease expense, kind of like a rent expense. Think of it that way. But if this is a finance lease, oh boy, it changes it dramatically. Then stuff starts to happen as if we owned the asset. And so it substantially transfers the risks and rewards of ownership to the lessee. So you report it on the balance sheet as an asset. You report it on the balance sheet on the right-hand side as an obligation. So you get the accumulated depreciation, and then you reduce the lease obligation. There's a depreciation expense, of course, and then there's an interest expense or a finance charge. And so remember, the operating lease is very simple. The finance lease is very complex, but the finance lease kind of sounds like all the stuff that we've talked about during this entire slide deck. But it's still a lease. It's not ownership. And that takes us through the long-lived assets. Next up are income taxes.